No matter what trading strategy you follow, aligning yourself with the trend usually gives you a higher probability of success. But here's the catch: trends don't last forever. Market reversals can sneak up on you and eat into your profits if you're not prepared. And let's not forget about those deep pullbacks that hit your stop loss even when your bias was correct. You've probably heard the phrase, "the trend is your friend," until it's not. And that's the tricky part, right? So, how can we confidently identify the true direction of the market and catch early signs when it's about to shift? Well, the good news is, there is a straightforward, mechanical approach to reading market structure and spotting those key reversal signals. And in today's video, I'm going to break it all down for you in a simple, step-by-step way. Whether you're a beginner or an experienced trader, this will help you build more confidence in your trade decisions. The market doesn't just move randomly, it flows in a pattern of impulsive and corrective moves, shaped by the behavior of traders and institutions. Impulsive moves are usually easy to spot. They show strong momentum, often with several candles of the same color, big bodies, and clear distance covered. Corrections or pullbacks, on the other hand, tend to look messy, mixed color candles, lots of wicks, and less overall movement. In a clean trending market, price typically forms higher highs and higher lows, respecting the previous swing points. Every time price breaks a structure to the upside, it's seen as a sign of trend continuation. On the flip side, when structure gets broken to the downside, it might be the first sign of a trend reversal. But here's where things get tricky for many traders. How do we know if a move is just a pullback or if it's the start of a new leg? Is that dip a true swing low, or just random internal noise that doesn't really matter? Now, here's why this matters. If that low is a valid swing low, then a break below it signals a potential reversal. But in many cases, the market just keeps pushing higher right after breaking those minor lows, and that's where most traders get confused. So, let me show you a simple and mechanical way to filter out the noise and focus only on meaningful pullbacks. This method uses Fibonacci retracement levels to gauge the depth of a correction. Here's how it works. Whenever the market makes an impulsive move, you grab your Fibonacci tool and draw it from the beginning of the impulse to the end. For a pullback to be considered valid, it needs to reach at least the 50% retracement level. If price doesn't quite make it to that level and bounces earlier, it's usually just shallow movement, internal volatility that lacks real strength behind it. In fact, they refer to the same areas as the discount and premium zones. These weak reactions often give off false signals and can throw off your structure analysis. By waiting for price to pull back at least to the 50% level or deeper, you're filtering out that noise and only paying attention to solid, meaningful corrections. In this case, we still treat the move as a single leg up, and a real reversal would only be confirmed if the price breaks below the most recent valid swing low. Let's take a quick example. We'll use the Fibonacci tool on a recent bearish move from the top of the impulse to its bottom. If the retracement touches or passes the 50% line, then it counts as a valid pullback. That shows us the market has paused enough for some profit-taking or short-term countertrend activity, adding structure to the chart. From there, if price resumes in the original trend direction and breaks structure, that gives us more confidence to look for continuation trades with clear market context. On the flip side, if the retracement only reaches around the 23.6% level or even less, we don't count it as a valid pullback. It's considered internal noise, and we treat the entire move as one continuous leg. In this case, there's no break of structure, and no meaningful swing high is formed. Now that we understand how to identify impulses and valid pullbacks, let's move on to the bigger picture, market direction. When we see 1, 2, even 3 impulsive moves that break above previous structure levels, that's a clear sign we're in an uptrend. If price then makes a pullback followed by another strong push, it confirms trend continuation. Here's a key point a lot of traders overlook. We only mark the lowest point of the pullback, the swing low, after a break of structure has occurred. That's important because during a correction, price can create several temporary lows, but those aren't our official swing lows. Breaking below those smaller, internal lows doesn't mean the trend is reversing. They're just part of the natural correction. The real swing low is only confirmed after the market breaks structure to the upside. Once that break happens, we go back and mark the lowest point of the pullback as our swing low. Only then does breaking below that swing low carry real meaning. It may signal a potential trend reversal. Now, let's talk about something really important. What actually counts as a valid break of structure? We've mentioned multiple times that breaking structure signals trend continuation, and it also helps us identify fresh swing highs and lows. But not all breaks are created equal. So what makes a break of structure valid? A structure break is only confirmed when there's a candle that clearly breaks and closes beyond the structure level. If price only creates a wick above the level without a close, it's not a true break. That wick shows that buyers pushed the price up momentarily, but it was quickly rejected back down. Often, this is a classic liquidity grab, where stop losses above the high get swept before the price reverses. But when we get a strong, full-bodied candle closing beyond the level, that's a valid breakout, and it gives us the confidence to update our market structure. We then mark the origin of that breakout move as our new swing low. As long as price stays above that level, we remain bullish and focus on buying opportunities. But here's the flip side. What if price comes back down and closes below that high-quality demand zone? That tells us something important. Buyers failed to defend the level, and now sellers are in control. The trend may be over, and a reversal could be starting. When that kind of shift happens, we say the market has experienced a change of character. It's a clear sign that momentum has shifted from bullish to bearish. But here's the thing, not every change of character is valid. There are two common scenarios where a break might look like a trend reversal, but it's actually not. Let's break this down step by step. In this example, we have a major swing low that led to the most recent breakout. A break below this level might look like a valid change of character. But if you look to the left side of the chart, you'll notice something interesting. This level lines up with a significant liquidity area. Here's what that means. Many traders who bought earlier placed their stop losses just below that level. So beneath that swing low is a large pool of liquidity, waiting to be tapped. And smart money knows that. So what do? They push price lower just enough to sweep that liquidity, triggering stop losses, before reversing the market back up. This move isn't a real trend shift. It's a liquidity grab, designed to trap retail traders and fuel the next big move. Before price turns back up in the same bullish direction, here's the key takeaway you need to remember. When a major swing low sits right in a zone loaded with liquidity, a break below it often isn't a real reversal, it's just a liquidity grab. So in that context, we don't treat it as a valid change of character. If price quickly reclaims that level and moves back into the range after the liquidity sweep, it can actually be a fantastic opportunity to go long. Why? Because the main trend is still bullish. The sell-side liquidity has just been taken out, and now the next target is the buy-side liquidity. As smart money traders, our goal is not to react emotionally, but to wait for the stop hunts to play out, and then ride the real move once the market reveals its hand. Now, that's just one part of the puzzle. Let's dive into another factor that can invalidate what looks like a change of character, and that's fair value gap mitigation. If you're serious about trading with precision, identifying FVGs should be one of the first steps in your market analysis. These gaps represent inefficiencies in the market, and they tend to act like magnets. Price often pulls back to fill them before continuing in its original direction. They're especially powerful on intraday timeframes like the 4-hour, 1-hour, or even the 15-minute chart. Let's go back to our earlier example. If you look closely at the left-hand side of the chart, you'll notice an unmitigated fair value gap sitting just under that swing low. Now, what happens? Price drops down to fill that FVG. But that doesn't mean the market is reversing, it's simply rebalancing. This is why FVGs are so important. They help us filter out false signals. So the bottom line is this. Always scan the left side of your chart for unfilled FVGs. And now, to wrap it all up, here's one final tip that might be the most important of all. Don't chase trades. Let the market come to you. Have the patience to wait for proper mitigations, respect your analysis, and only enter when the market gives you something clear and actionable. That discipline is what separates consistent traders from the rest. Alright guys, I hope you found value in this video. If you did, be sure to smash that like button to show your support. And if you're new here, consider subscribing for more smart money trading content just like this. Thanks for watching, and I'll see you in the next episode.